Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I must have done something right because I'm joined again for the second week in a row, I think, by our two economists, Giovanni, Zanni, and Deepika, Dayal.
Hey, Imogen. Hey, dear. So, before we talk about the US, Imogen, this week is definitely about the UK. We got the UK CPI yesterday, and I'm pretty sure that would have been a disappointment to the BOE, especially with the numbers that we got on the services inflation. What is your take on that?
Yeah, I will say we're recording this on Thursday afternoon and Wednesday morning already feels like a lifetime ago. So as you pointed out, Deepika, I think it was a very disappointing print for the Bank of England. The service inflation part of the print was really the most important part that we were watching, that the Bank of England would have been watching. They kind of elevated that recently as one of the most important indicators of inflation persistence. And that came at 5.9% versus the BOE's own projections of 5.5 and market projections of 5.4. And so a considerable, surprise to the upside on the BOE's own numbers. But I think it's important to remember here as well that 5.5 is revised up from 5.3. So it felt like they had raised the hurdle for services inflation to surprise to the upside, and yet it still did quite significantly. Which, I think really throws a spanner into the works for the BOE, who had quite clearly signaled a couple of weeks ago that they thought, it wouldn't be that long before they expected to be ready to cut rates. I mean, they've sort of avoided really wading in on this kind of June versus August debate. But they were pretty clear that was, June was live, and August sort of by definition, I guess, was as well. And, recent speak from the kind of majority seven, if you like. We've heard from Hugh Pill earlier this week. We heard from Broadbent, and they both sort of pitched this idea that should the data come in line, they would start thinking about cutting rates through the summer. And this data wasn't just not in line, but a significant surprise to the upside. The market reaction was a little bit muted, and I wonder if part of that, well, not muted, but muted in the context of market reactions, I suppose, that we've seen to other data prints. For example, we've seen almost as big a reaction in kind of 10-year yields and out on the day of a beat to US CPI, for example, and it was perhaps a little bit more muted than you might have otherwise thought had you seen that data the day before, let's say. But I think that, that comes down to the fact that there was probably a sense amongst market participants of kind of questioning the validity of that one print, not wanting to read too much into one print, but certainly wondering, how much of it could potentially be reversed in the coming months. And it was sort of considered, certainly heading into the data, how much of the fact that April being a key kind of indexation month in terms of being the start of the fiscal year and therefore index-linked products, I'm thinking here like your phone contracts, for example, that are inflation linked, reset in April, and therefore that would have a kind of outsized impact on the CPI data. But actually, when we look across the categories, it was actually fairly broad-based strength. It wasn't like there was just one category that saw an outsized jump that was driving the upside surprise. And additionally, it wasn't really your traditional kind of index linked sectors that were driving that upside surprise. So by that I mean communications, for example, which includes those telephone contracts, internet, etc., like I was talking about. Actually, inflation dropped rather than rose there. So I'm not convinced that this is a one-off, and of course the BOE will need to see more data to confirm that. But I do think this complicates things and certainly makes a June cut very, very unlikely at this stage. We retain our call for the first cut in August, although it does feel marginal. And I think you do need to see these inflationary pressures come off quite a bit before August to pave the way for that. And we now see just 75 basis points of easing rather than 100. We previously were kind of in the 100 basis point camp this year with risks of 75. And I think now we'd put ourselves in the 75 basis point camp with risks of 50. And we've also taken out one 20 25 basis point cut. Oh dear, one 25 basis point cut in 2025 as well. So we previously had a kind of terminal or neutral rate, if you like, of 3.5% by sort of Q3 2025. And now we think it's more likely to be probably 4%. For gilt yields, I think it just means that we get back to that kind of 4% level that we've been talking about as fair value a little bit more slowly. You know, our fair value model, if you like, has inflation and our bank rate view, or core inflation and our bank rate view, both as inputs. And therefore, if we, you know, revise up both of those things, I think it's natural that we would see in the near term an upward revision to how we see yields evolving. So I think that we could still trade closer back to recent highs. So in 10-year gilts, for example, that's probably closer towards 430 or higher than that, 435, before maybe getting back down to 415 by the end of the year, and not kind of trading in a sustained manner back at 4% really until 2025. So it's not a major overhaul of our views, but I think just slightly less easing, potentially coming slightly later, and therefore gilt yields falling on a slightly more shallow trajectory, should I say.
Thank you for that. But there was another surprise yesterday for the markets, which was the announcement of the UK general election by Prime Minister Rishi Sunak. What's your take on that for markets?
Yes, and I will publicly admit that probably my worst take as a UK rate strategist was telling everyone yesterday morning that I think it would be unlikely for him to call a UK election as soon as July. So I'm happy to put that on record that I was very surprised, but I think everybody else was too. We'd all been gearing towards an autumn election, which would allow, you know, time for the Conservatives to potentially get in another fiscal event. I think there was a combination of things this week that probably drove the decision towards announcing an early election, both on the fiscal side, so the fact that, you know, there's now potentially 10 billion of kind of extra spending as this compensation, given the conclusion of the infected blood inquiry, that reduces the fiscal headroom or reduces their ability to deliver some additional easing in the autumn. Plus you have, after, you know, the higher than expected inflation, a potentially shallower easing path from the Bank of England, so less reduction, if you like, in debt servicing costs than you might have had in your baseline scenario, which again reduces that fiscal headroom, and potentially some, you know, view that actually this is the kind of sweet spot now in inflation, because when you look at the breakdown between services and goods price inflation, we are kind of in that sweet spot of energy base effects still bringing down goods price inflation, but actually it won't be that long before those kind of base effects wash out, and we could see an uptick in headline inflation away from that 2% target again. So here we are, an election very narrowly in the second half of the year, as they had always promised. You know, the market barely moved on the announcement yesterday. And I think that really highlights the fact that this is, you know, in our sort of best case or best guess of a central scenario at this point, given the way that polls are projecting the kind of seat split and the way that betting markets are projecting the outcome of a sizable Labour majority, it feels like that's going to be fairly market neutral, in the sense that markets will probably be most concerned about what a change in government will mean from a fiscal policy perspective. And given the very limited fiscal headroom, actually a change in government as soon as July really doesn't move the needle all that much in terms of fiscal policy. The risk case, I think, for markets, for rates and FX really, is that you start to see the polls narrow, or Labour underperforming the kind of what the national polls are telling us right now, and therefore you worry about a potentially smaller Labour majority or even a hung parliament. And markets would worry about that just because I think they would worry more about the risks of fiscal slippage and eventually probably tax rises to offset some of those higher spending demands that the Labour government might have to meet in order to kind of satisfy the support from its base. So your risks, I think, around the election are minimal at this point. But if I was going to highlight a risk case, it would be still again towards higher yields and this kind of supply demand imbalance weighing even more on the curve than we currently think it does. But I'm sure we will be talking a lot more about the elections over the next 6 weeks. So perhaps we move on to Europe, where there are elections there as well, planned for the beginning of June. But it feels like markets are not talking about them very much or paying a huge amount of attention to those European parliamentary elections, Gio. Why is that? And are they right, you think, to not pay much attention at this point?
So as you say, I mean, elections are even closer to today in Europe. It's only 2 weeks away. It will be between the 6th and the 9th of June. And yes, I mean, the interest on those elections has always been less strong than for national elections. They have tried to stir a little bit the interest by talking about black wave. It was already the case in 2019. It didn't materialize. Actually, it was more of a green wave at the time. It's true that if you look at the polls, you will see that there has been an increase in the likely seats going to the far right parties. But we're talking about moving from around 10% to 15% of the seats. So it's not something that's really will change the fundamental equilibrium in the European Parliament. And also, if you look at the polls, really they've been super stable over the past several months. I mean, of course, there was some volatility at the country level. For example, AfD in Germany was up a lot until recently, and then has been basically crashing down with a lot of scandals. But if you look at the aggregate numbers, and that's the beauty of aggregation in the sense of the European level, there's really little support for a shift in power in different ways. So the most likely outcome will be a continuation of the current majority, which is like a center-left, centrist and center-right, essentially. Of course, there are some discussion if the polls are completely, if the numbers are not completely in line with the polls, you might have let's say the temptation of doing something that we are seeing right now in the Netherlands, for example. So the liberals going with the right and the far right, but it's really very, very unlikely. At the country level, you could have some more relevant repercussions. I'm thinking about France, to be frank, because it's where you can see in the polls a very large discrepancy appearing between the Rassemblement National from Madame Le Pen and the Macron's party. So that could create some wave. At the same time, the Rassemblement National already was first in 2019, already was first in 2014, and there is some separation between European election and national implication. Probably the most interesting part of the story will be the formation of the government. Who will be the president of the Commission? Von der Leyen again, Draghi, who knows? But that's in preparation of the coordination maybe with the new UK.
And just away from the politics then and back to monetary policy, we obviously had the somewhat key, I suppose, wage data this week, although, it was for Q1, so a little bit backward looking, but it was one of the prints that the ECB had kind of flagged that they were watching to wait for confirmation that, this downward trajectory was as they expected before cutting rates in June. I'm going to assume that this doesn't change your base case for a cut in June, but perhaps you can just comment on what it might mean for, after June as well.
Yeah, it's an interesting data and approach from the ECB, actually, because they put a lot of weight in forward guidance on this data, on this Q1 number. And then the number actually came out a little bit stronger than expected. So something that should have created some doubts on their policy, but they were very quick in like diffusing that bomb, that small bomb, by issuing like immediately with the release of the data a blog explaining that actually it was a backward-looking data, that all the numbers that they had were showing continued disinflation, continued deceleration in wages to be expected for the rest of the year in 2025, and actually numbers that were below, slightly, but still below their projection that they have put in March for the last iteration. So we're in a situation where, because of one-offs, especially in the public sector in Germany, we have a slightly higher number, but the interpretation from the ECB now is that it doesn't really matter, and we are in this kind of disinflationary trend as before. I agree with that. That has been my view as well. So I will not, make nasty comments about this kind of forward-looking insistence from the ECB before. The other thing I would say is that we had also another piece of data that is of interest today, and it's the PMIs, and especially in the PMIs, apart of the fact that they are showing some continued modest recovery in activity, but they're also showing two things. First of all, that prices are still moderating, and also that the difference between output pricing and input prices, so a kind of indicator of compression in margin, profit margins, showing that also the other element of the puzzle are going in the right direction, and that the kind of prospects for wages and for inflation are still for this moderation. And yes, so that's no change to a rate cut in June. Then we never had July as a rate cut date, but I still think that September is a very likely date, and then December in our scenario. The US is the main kind of uncertainty there, although it hasn't had a major impact on the short term so much, but of course that's less the case for the long end.
Thank you. Okay, last but not least then, Deepika, let's switch over to the US quickly. It feels like for the first time in a long time, the US took a bit of a backseat to everything else that was going on this week. But we did, of course, have lots of Fed speak, and perhaps one of the highlights within that was the publication of the minutes from the last meeting. What was your take on I guess, what we've learned from Fed speakers in general, and particularly from the minutes this week?
It was a fairly light economic data calendar week, so the focus came to the FOMC minutes from the May 1st meeting. And in our opinion, the minutes didn't offer any new insights into the Fed's thinking on monetary policy. However, market participants did home in on the text around elevated inflation risk, with many considering that the Fed could actually hike at some point this year, because the minutes specifically said that various participants mentioned a willingness to tighten policy further should risk to inflation materialize. However, in our view at least, the risk to inflation that Fed officials were talking about at the May meeting have sort of abated with the recent data, which Fed officials didn't have at the time of the May meeting. So at the May meeting, they had three very strong inflation prints, with both core CPI and the core PCE deflator, which is the Fed's preferred inflation gauge, averaging 0.4% for the entire quarter. That was a slight departure from the weaker prints that we'd seen in H2 of last year. So at that point, for them to be cautious about inflation risk and being willing to stay patient on monetary policy made a lot more sense. Since then, we've had a lot of Fed speak from some of the key officials, including Chair Powell, Vice Chair Jefferson, Governor Waller on Tuesday, I believe, who said that they are willing to be patient on monetary policy till they have greater confidence that inflation is sustainably getting back to 2%. So far, they've not seen any evidence of that. But at the same time, they've not seen any evidence of any reacceleration in inflation, which could warrant a hike at some point down the line. But given the April CPI report, the softening in momentum that we saw with the payroll data, the ISM measures, the retail sales data, there's very little evidence that they're considering a rate hike to be a base case, or a departure or a change in the base case. So in our opinion, the message from the minutes was, yes, interest rates are likely going to be higher for longer, but there was no about turn in terms of monetary policy actions in the months ahead. Of course, there'll be the next test for inflation for the Fed would be next week's core PCE data. We're looking for a downshift in the core PCE measure with a 0.2% estimated gain after back-to-back increases of 0.3% and a hefty 0.5% gain in January. However, as we've said before, looking ahead with the strong Q1 data prints and unfavorable base effects in the months ahead, optically at least, it'd be tough for the Fed to say that they've gained enough confidence on the inflation mandate in the coming months. On a year-on-year basis, our own estimate is that the core PCE growth rate ticks down from 2.8 to 2.7, but we expect it to stay closer to that range over the next 4 to 5 months. Our own expectation is that inflation gets closer to the 2% target only towards the end of the year, which is when we're expecting the first rate cut at the December meeting.
Right, let's leave it there for today then. Thank you both for joining me. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.